Good morning, everyone. Welcome to this update for global stocks and commodities for the 22nd of March and another real roller coaster week. This is going to be a longer version for obvious reasons today. There's a lot to talk about, so maybe you want to go and grab a tea or a coffee before you start listening to this. Look, as everybody knows that's been watching the videos that I do for any length of time, knows that I have a fundamentally bullish attitude to life, and it's just how I seek to live my life, and I think it's a good thing, and I make no apologies for it. As long as you're not blinded by that bullishness and that you can acknowledge when things change, then I think it's a good thing, because that bullishness allows you to search for and to see opportunities that that negative people just shut off and don't tend to see. So I continue to be I think, realistic about where we're at the moment. Certainly, it's now very evident that a change of tack is required, but that does not mean going negative. That just means that we need to change some of the processes, and that in this sort of volatile environment, the opportunities just open up all over the place. So, this video today is really about looking forward, not wringing your hands about what's just happened. There are always opportunities. 2008 showed that, and they may not be here right at the minute, but they're certainly coming. That's for sure. All right, let's jump into it. Last week, the headline was the mammoth reversal, which is what we had on the Friday night. It was a reversal for the ages, and normally one would expect that to follow through. But between recording the video last Sunday morning and Sunday evening, a great deal changed, not only in Australia, but also around the world, with governments moving very quickly to effectively close borders. And I was monitoring it during the day, and it became evident to me that by mid-afternoon on the Sunday, that markets were going to turn down again heavily on the Monday morning, and that's certainly what happened. And I advise members of that. We've never seen anything like this in our lifetime, and hopefully we won't again. It's really quite an extraordinary event, and it's still a bit surreal. I guess everyone is feeling the same, that the interruption to our life has just been so profound and so sudden that I think it has just left everybody quite stunned. So I want to talk about how to think about the current situation as far as the stock market goes, actions that you can take, and then ultimately how to repair the damage, because the damage can be repaired. So, you've got to move forward positively on this. We'll obviously touch on the normal stock and commodity trend update, and portfolio analysts last week looked at just why the fall was so severe, and actions that you can take. So let's look at the week in review. The world just changed incredibly. I mean, I was just when you hear things like the state of California is effectively on lockdown, I think that's like 40 million people or something. It just gives you a sense of how incredible this change is. The rule books, as far as the market, are pretty much out the window. So, forget a lot of the old relationships, because there are things going on at the moment that just defy logic. There is absolutely massive intrusion into our social fabric, the things that we normally do, the sport that we watch, just the way we live our lives, the way that we shop, just do normal everyday things, has just been turned on its head. And the economy is changing in ways that were completely unimaginable just a few weeks ago. And I understand that Scott Morrison this morning will be unveiling something like a $60 billion stimulus package to help particularly small businesses pay the wages of staff to keep them occupied, to keep them solvent, I guess. What it does do, and what this has really rammed home to me in the last week or two, is that it does demonstrate the vulnerability of the financial system. The fact that something like a virus could, bring the financial system to its knees. Now, life will get back to normality, but it's going to be very different for quite some time. And, most governments seem to be talking of the order of 6 months of social distancing and lockdown, and possibly longer. It's a complete unknown, but it would appear that it's not going to, life is not going to go back to normal very, very quickly. One of the things that bothers me is the fact that governments now have reduced, or central banks have now effectively reduced rates to effectively zero around the world, even here. And yet we've still got a bunch of unresolved issues, and we've got double the debt that we had in 2009. I wasn't expecting that. Normally, the interest rate cycle would move back up to a level, and then that would give central banks more ammunition to play with. But clearly that is now not the case. We've still got the issues. We've still got lots of debt. So it's not a good situation. However, it doesn't mean that it's the end of the world. So I don't get that impression at all. The point I want to make here is that the investing approach that everyone needs to take has to change, and change a lot. Unless you're in a position where you've just got such a large nest egg that it doesn't matter. You don't need to do anything. Dividends are going to be cut and suspended. There's absolutely no question about that. So it's going to be a case of most people are going to have to think differently about how they how they invest their money from here on. Now, just moving on a bit, any projections that people want to try and make at the moment, either about the virus or about the effect on economies or the effect on the stock market, are just completely useless, because there are just too many unknowns. So, just don't even try to go there, because it's just a useless exercise. It's going to be a bad period for a while. We're going to have to make enormous adjustments, but mankind has always shown that it's been very ingenious, and I'm sure that that's going to happen again. But this is a wake-up call. That we've got greater risks out there that are not being acknowledged. Now, I don't know the probability of those risks coming to pass, because it's just way too early to say. But I do know a couple of things. It's now no longer appropriate to assume that they won't. And I'll put my hand up and say that I've been someone that's, had the attitude of play the ball as it comes down the pitch, deal with the facts as they stand at the moment, don't indulge in doom and gloom conjecture, and I'm not about to start doing that. However, realistically, I am having to shift my position from assuming they won't occur to now at least factoring in some worse circumstances a bit more than normal. And I think that's only sensible. I also think that a long-term hold mentality for most people, now if you've got lots of money, then you can probably just, wait this one out. But it's possible, if things do get really bad, if the virus continues for some time, that a long-term hold mentality might be pretty unwise, and I'll explain more about that as we move through. The best compromise that I can find between my normal approach and accommodating the new reality is really what I want to talk about, and that's what I've started rolling out to members. So I want to present two scenarios, and these are just two scenarios of many. So I'm not saying that either of these will occur, but to a degree they're either end of the spectrum. So scenario one is that normality is achieved before the end of this year. So the border restrictions are lifted, life and trade goes back to normal. And I have no idea whether that'll be achieved or not, but that's probably looking at best case scenario at the moment. But there are still too many unknowns to be confident about that. So therefore, I think everybody should be holding significantly more cash for strategic reasons. You want, not just because you're going to hide in cash, because cash is not a good asset to be in at the moment. You're going to lose money holding cash, But if the cash is there for strategic reasons to use when opportunities present, then then that's absolutely what you should do. So I think you should hold significantly more. You need to own only the highest quality assets because they are going to prevail. Now, I can't tell you that they won't go down further, and if things get nasty, they could go down a lot further. But quality assets will prevail. The one thing that everyone needs to do is to avoid companies with high debt because they're really looking at a very, very bleak couple of years, and many will not get through it. You should consider some hedging if you know how to do that, and that's beyond the scope of this video, but that's something that I will be discussing and recommending to members. You need to be able to cash in on rebound opportunities, so therefore you need to know what, and you need to know what the signal looks like, and then you need to be prepared to pull the trigger. Having done that, you also need to be very ready to take partial profits, because I just don't have a great deal of faith in how far any rallies may run, and there will be rallies. And what I'm going to do in a couple of days, I'm going to record a separate video where I'm going to go back and pull apart the 2008 period into 2009 and just look at how the market behaved, look at the nature of the rallies, when they occurred, how far they went, what they looked like, to try and give you a sense of where some of the opportunities might lie. The one thing that I think you want to try and avoid doing is making huge adjustments all at once, or any particularly large bets. You want to do it a bit progressively. Now, scenario 2 is a lot worse. Scenario 2 is that the virus is around for a lot longer, borders are closed, the impact on the economy is far worse, the bond market becomes dysfunctional, and it causes a spiral down throughout all asset classes. And the bond market is far bigger than the stock market. So dysfunction in the bond market would be, frankly, a disaster. And that would be a situation that would cause stocks to go a lot further down and for a lot longer. So that's the worst case scenario, and we hope that we don't get to that point. But we should now be open-minded to the fact that it's possible, it could happen, and we need to be responsive to that possibility. Now, I certainly wouldn't be setting up your investing activities on the basis that it will happen. I think that's not sensible, but at least be open-minded and be looking for the signals. Now, if scenario 2 were the case, so this is not a recommendation to raise cash levels to 50% plus, but this would be more appropriate if scenario 2 was going to kick in, and that will become apparent as months unfold. And you would definitely want to put some hedging in place on the rallies to protect the part of your portfolio you kept open, because markets would be incredibly unpredictable. So again, let me stress, these are not recommendations. This is just scenario 2. I'm just painting the two ends of the spectrum. And chances are, under this scenario, you're going to have to be more active. That being a long-term buy and hold person is probably not going to be very wise at all. And I would also strongly suggest that going passive via long-term ETFs might actually be quite dangerous, because there's dynamics, and I've talked about this regularly for 2 years, there are dynamics around the ETF market that could really unwind very severely. So ETFs may not be as defensive as almost everybody thinks they are. Let's look at the unknowable dangers, because we are going to have a very different world, at least for a period of time, probably the bulk of this year and possibly longer. I still remain very bullish on wisely selected individual stocks, and there are some parts of the market that are actually poised to do really well, and gold stocks is one of them for a start, but there are others. So you can be entitled to remain bullish on certain areas of the market, and they're going to do incredibly well. You look at what GDX did, the gold market coming out of 2008. You look at what it did in 2016. You can make hundreds of % gain in the gold sector in relatively short periods of time. So these are the positives that you need to think about. As far as the general market goes, I'm far less sure. I'm quite apprehensive about the rest of the market, but I'm bullish on certain sections. We've now got global debt close to 300% of GDP as an average, and that's obviously going to surge dramatically because governments are just going to be printing money like there's no tomorrow. And there is certainly a lot of economists are talking about the need for governments to move to 20 for debt to GDP to move much higher than where it is at the moment, and stimulus levels of perhaps 20 to 30% of GDP. So global debt is going to go much higher. We can get away with that with interest rates effectively zero, but what if interest rates either have to move up to combat inflation, or because market forces just cause interest rates to move up? There is a massive amount of government bonds coming to market, and to get them away, to get people to invest in them, they may have to offer higher rates. And the world's debt can't cope with even a small increase in rates. And that's why if the virus impact is longer term, then it really does raise risks around the bond market. So we need to look at what assets are going to do well in that environment. And it's very obvious to me that there are a few, not many, but there are a few that will do quite well in that environment. Technology, it seems to be assured of having an amazing future. The process of digital banking and the process of artificial intelligence and 5G and all of the benefits that's going to bring throughout the economy, they're just too substantial for technology not to continue to have an amazing future. But the question in my mind is the market has been prepared to pay, perhaps between 20 and 30 times multiple for these stocks like Facebook and Microsoft and Amazon and stocks of that nature. Will there be a shift in attitude for a lengthy period of time where the market is no longer prepared to pay those sort of multiples? And whilst these companies are still growing and doing well, they actually will be marked down to a lower level of PE. They might be marked down to a 12 to 15 PE. So they're the sort of things that are in the back of my mind at the moment. So in a panicked world, could multiples be wound back significantly? And that's why I'm sort of shying away a little bit from the long-term buy and hold type of approach. And of course, the final thing is, are we headed for a world now where everything is so much more interconnected? Is counterparty risk going to be an issue? In other words, the other party that you're doing business with, could they become insolvent? So these are all things that came up in the GFC, and we got out of the GFC, and we'll get out of this. It's just a question of how bad does it get before it gets better. So let's look at the American stocks now. The S&P fell 15% on the week. That's absolutely massive, 406 points. Junk bonds got absolutely hammered, as we'll see. And that's a reflection of what's happening in the corporate bond market. The VIX index has remained above 50 now for 2 weeks. Even that didn't even happen during the GFC. So the impact on the VIX has just been incredible. Friday there was a heavy sell-off on Friday, particularly in the last couple of hours. I think we should really just ignore what happened on Friday, because it was the triple witching session where you had expiry of stock options and futures contracts, and that always creates a great deal of distortion at the best of times. There were a huge amount of put options that were very, very deep in the money. Market makers had an incentive to push some of those stock prices up to lessen the pain of those options expiring. So I would encourage you to, when you're looking at the charts, ignore Friday, because it could prove to be a bit of an aberration. Corporate buybacks have probably effectively ceased because companies now are going to be hoarding capital. And corporate buybacks have certainly been providing part of the floor in the market for many stocks. So that's one source of buying that's probably going to go away for a while. There are a few stocks, however, where it's pretty obvious that, well, let me back up one. The market has been opening with a gap down most of the time, and some stocks don't ever recover from that during that session. But there are a few stocks that almost always every day close higher than what they open. And that's a real sign of strength. It shows that those stocks are being accumulated during the day, and they're the sort of stocks that are going to do the best coming out of this this period. Now, the US dollar absolutely took off like a rocket up to 103. So that's been absolutely enormous. And the 10-year yield slipped back a bit to 0.85. The US dollar strength is going to be a huge impediment for America because it kills their trade competitiveness. Now, at the moment, that's probably less of an issue, and they've got so many issues to deal with. But medium to longer term, you've just got to expect that America is going to wage an all-out assault on the strength of the US dollar. Because it's just not in their best interest for the US dollar to be up here. And that's going to be pretty good for gold when that happens, and I'm sure it will. They'll eventually get to that point. All right, let's go to the charts. This is the S&P. So on a monthly chart, you can see it's just been a massive, massive down month. And if we go back to before 2008, you can see, just the dimension of it. It's quite extraordinary. Let's look at it on a daily. So this was the low in 2018. So that was when central banks were trying to raise rates. We may find some support, say down around here, somewhere around about the 2150, 2200 level. We've broken this low. So from a purely technical point of view, we've now really got perhaps another 200 points, so perhaps another 6, 7, 8% on top of what we've already had to get down to the next level of support. So certainly it looks pretty grim for the index from a technical point of view. Let's have a look at the junk bond market. This is HYG. Pan back here, and you can see it's been a very, very dramatic fall off in the junk bond market, and this is probably my greatest concern at the moment, is what is happening in this market now. If the government, just throws an absolute truckload of liquidity at the bond market, then this could reverse around. But look, this is certainly one that can trigger a lot of trouble in other parts of the market. Let's look at the US dollar. So absolutely surged off the map in the last 2 weeks. You can see it started to broke down out of the uptrending channel, broke down out of the sideways channel, but this virus has just changed everything, and we finished back up at 103. That, of course, punctured the Aussie dollar, and the Aussie dollar got down as low as 51 intraday. Sorry, 55.1 intraday. So it's been a meteoric decline by the Australian dollar, which was trading. We were trading at 70 cents at the start of the year. So we've dropped from 70 cents to 58 in a very short space of time. Let's just look at the ASX 200. And you can see it's been dramatic from 7,200 down to 4,800. And it'd be a brave person to say that we possibly couldn't go down further. But again, we're approaching some possible support. So any of these bear markets like this always get rallies, and the snapback rallies can be equally savage. So it's pretty unpredictable at the moment. All right, let's move on. So this is just a chart that I thought was really interesting. At the end of the day, money goes where it's treated best. And the yield on the S&P has risen in the last few weeks, obviously because prices have come down. Those dividends, of course, may also come down, so this may all be historical. But the 10-year Treasury yield has dropped so much that what it's done, it's put the gap between them has gone up this year from around 1.5 up to about 4. So that means that you can get you're getting around about 4% yield, better than you can get on the Treasury yield. So therefore, the stock market yield is far more attractive than the Treasury yield, and so the stock market is going to continue to get its share of fund inflows purely on that basis. Let's look at Aussie stocks. The Australian dollar plunged down to 55.1, and we just smashed through the 60-cent support level like it wasn't even there. It's really the whole fear environment and, of course, the US dollar. Our next main support kicks in at around 50 cents. Now our market fell, I think it was down 11% last week, down another 13 this week, so we fell 723. The market was actually up around 4% on Friday, but ended up only up 1%, so it lost 3/4 of that gain, and of course that followed through on Friday night in the US. Now there are a few stocks in Australia that are higher than before the crash, believe it or not. And members know very clearly what those stocks are. And they're the sort of stocks that you really want to sit up and take notice about, because if the price can't fall during what has just been thrown at us, then it's very unlikely to happen. So they're the stocks that are going to do quite well out of the next period. Most of the stocks are too early to move on, but there are bargains building very, very quickly. There's some tremendous buys in Australia, but look, we could be way too early, and there could be significantly lower prices first, so you don't really want to be moving on them yet. But there are a couple of exceptions to move on now, and we've done that in the last week or so. Let's move on to precious metals. Gold plunged all the way to 1450 before it closed at, that should be 1500. The simultaneous dumping of government bonds and stocks shows that there are really serious issues at play with the financial system. That shouldn't happen. Money moves out of stocks, goes into bonds, goes into the US dollar. Well, it's certainly going to the US dollar, but the dumping of government bonds at the same time that stocks were being dumped is a pretty bad sign. That indicates significant liquidity issues. It also indicates significant leverage that needs to get washed out. Gold is being held back by just the short-term market dynamics. I've talked about that over previous weeks. It's the need for liquidity. The need for cash may be in other completely unrelated areas, not in gold, not even in stocks. It could be in the other areas of the derivatives market, currencies, bonds, whatever. But gold is something that's liquid, can be easily sold, and so that market dynamic has been holding gold back. And of course, the US dollar strength has kept a lid on gold as well. But as I've pointed out, either last week or the week before, in 2008, the gold sector was the first one to start turning up in October of 2008, which was 5 months before the low, and it outperformed the rest of the market for the next 3 years. And it'll do the same again. So now it's a matter of when the gold market turns up, not if. So when this drive for liquidity reaches its climax, then I think we'll see gold really start to move. If we look at precious metal stocks, the profits are soaring, obviously, with the gold price doing what it's doing, particularly in Australian dollars. The Australian dollar gold price is about $2,600, and the all-in sustaining cost for most of our miners is around about $1,100 to $1,200. They're making a massive profit margin. They've also got very robust cash flows, and that opens up many opportunities. it allows them to spend more on exploration, to increase their production. It allows them to make acquisitions, so they can either explore to increase their reserves, or they can acquire. So it opens up tremendous opportunities for the gold miners. The local earnings of our gold miners are rising very quickly, but the prices have been held back by sentiment and by the gold price. At some point, this is all going to explode to the upside. May not be just yet, but gold stocks are now cheap, and this is certainly one of the opportunities of the next 6, 12, 18 months. All right, let's take a look at some gold charts. So we'll start first of all with gold. We'll do the weekly. So there's the weekly. Gold has dropped out of that really steep uptrending channel because of liquidity concerns, but it'll bounce back. I think that's I'm pretty confident about that. It's really just the timing of it. So it's been a fairly sharp move to the downside, but you can see we're starting to stabilize now. And we're certainly oversold in the gold market, so it may not be too far away. If we look at GDX, so it's equally been, the impact on the stocks has also been, pretty devastating as well. But I think this is one of the better opportunities out there right now. Okay, moving on to other commodities. Copper just fell apart down to 218. The currency impact certainly played into it, but there's just a whole lot of market dynamics that some of them are expected, some of them are unexpected at the moment. That's just causing price moves that you wouldn't see. Crude oil got smashed again, hit a low down around 20, finished at 23.8. And that represents a 42% drop in 2 weeks. No wonder companies in the oil sector are going to be hard pressed to handle that. And in particular, in shale oil in the US, it's an absolute time bomb because those guys need prices above $38 to $40. They've got huge debt levels through the issue of corporate bonds. They're not going to be able to. They're not going to have the cash flow to service those interest payments, and further down the track, they're going to have great difficulty rolling those bonds over. They're not going to be able to redeem them. They're not going to be able to roll them over, and the natural consequences of that is bankruptcy. So that's a really bad area, and that's where a lot of my concern stems from, is the impact of US shale oil on the rest of the corporate bond market. There's spot copper. It's dropped quite a lot. In fact, that chart really doesn't reflect that big drop. I may not have changed that chart from last week, but certainly we're down around the 218 mark. There's nickel, and my final thoughts, and I've got quite a few of them to wrap it up. There is going to be a huge hit to economies and profits, so no argument about that. But I just want to make a point, because there's been people over the last decade that have been calling a top, over and over and over again, and they were just wrong for 8 years, and they missed out on an enormous amount of profit that was in the market. So right now, trying to call a bottom is equally negligent. But I do want to, and I'm not calling a bottom. I have no idea where the bottom might be at this point in time. But I'll just make this observation, that great wealth comes out of situations like this, where there is literally blood in the streets. And that's when the people that have got a clear game plan and, frankly, the guts to step up can create a great deal of wealth. So I want you to focus on that point, on the opportunity, and not on the situation that we find ourselves in at the moment. And the last thing that you want to do is to listen to these people that have been wrong for years, because they're just going to intensify their sky is falling in type rhetoric. And what that'll do is it'll get in your head, and it'll stop you being open-minded and looking for the opportunities. So, don't seize on the people that are writing all the doom and gloom stuff, because it's just serves no purpose at all. In fact, it serves a negative purpose. Look for the positives. Just I mean, the government stimulus around the world is just incredible, and it is going to have an impact. Obviously, a vaccine is going to have a huge impact whenever that is going to come to pass. In Australia, it's a fact that there is $25 billion in dividend checks coming in the next 3 weeks. That's not a guess, that's a fact. And all that money, or not, sorry, not all that money, a lot of that money is going to go to institutions. Some of it goes to mum and dad investors, and they may well be motivated to hold put that in the bank as a cushion, and they may not want to reinvest it in the market. But a huge proportion of this is going to go to institutions, and institutions are not going to sit on cash. They're going to put some of that back into the market. So that's a positive in the Australian market. We've got parts of Asia clearly getting back to work. Now, I know some people are still skeptical about data out of China, but there's irrefutable evidence. If you take the trouble to look at the comments being made by some of Australia's CEOs of our largest companies, like Cochlear, for instance, are saying that the China supply chains are up and running. If you look at comments from CEOs of US logistics companies that move goods in and out of China, they're saying that the logistics are back on track. Goods are flowing, to and from the ports. So there's certainly evidence that parts of Asia and the supply chains are being re-established. And something always does well in a crisis. Gold is going to do well out of this, and there are going to be other things. I strongly suspect that stocks like BHP are going to do reasonably well out of this when things do turn around. You need to ensure that your perspective is calm and based on facts. So, try and don't read a lot of the really negative stuff. I know it's hard, but, just try and not do it. In general terms, it's too early to be offensive, but there are, or to go on the offensive, but a few opportunities are available right now. There's not many, but they are. There is no question that we can profit in a bear market in all sorts of ways. So don't think that a bear market is it's going to be a one-way street and all you're going to experience is pain until it finishes. There are numerous ways you can profit in a bear market. And if you don't know how to do it, then you need to align yourself with someone who does. You need to stay open-minded. Is the most important thing. Don't start to build up preconceived ideas about how it'll play out. Now, just touching on the point about profiting from a bear market, it's not easy to do because, our emotions are being really challenged and pulling the trigger can be really difficult. But it can be done. Most people are going to need some guidance on that. And they also need to shed some of their currently held beliefs and biases about the market. Hedging is going to play a part. We're going to have rallies and we're going to go down again to possibly lower lows, possibly higher lows, I don't know. But hedging will play a part. Patience is really important because it might be months before the opportunity that we're waiting for presents itself. So you've got to resist the fear of missing out. If you are just thoroughly put off by what's happened, you're thoroughly disgusted, you feel sick in the stomach, and you want to toss in the towel, then you're going to realize your losses. I really don't recommend that. You can be a lot smarter than that. So don't toss in the towel. There are many ways that you can repair the damage that's been done. So you need to learn how to fight. It's a time where we've got to fight. The tools out there to fight with exist. You just need to learn how to use them. Portfolio analyst coming up. Obviously, it's about reorganizing our portfolios to this new environment, which is just so different to what we've had. That's it for this week. Sorry, it's a bit long, but I know at this time that people appreciate the perspective. There's my contact details for anyone who's not a member. The portfolio analyst trial is there for anyone that would like to trial that for 2 weeks, and we'll see what happens in this week coming up. I'm sure it'll be momentous, whatever it is. That's it for this week. Cheers.